But our next guest is not ready to declare victory when it comes to corporate profits just yet, not with concerns still swirling about a slowing economy. Ed Yardeni is president of Yardeni Research. He joins us once again now. So it is true. I mean, first quarter earnings surprised pretty much everybody. That's
Yep.
fair to say. But you don't think that means that we're going to have smooth sailing here?
Not really. I think that the impact of tariffs is still going to be substantial on the second and maybe the third quarter as well. Look, the surprise so far seems to be we're not getting that much inflationary pressure. We're seeing some areas of like the ISM Purchasing Managers Indexes that suggest that we could see some inflation. But I'm looking at the Cleveland inflation nowcasting, and that still suggests that May and June inflation is running around 0.1, 0.2%. So where are all these tariff costs going? We know that the duties that they're collecting have gone up, and so it may very well be coming out of profit margins. So I think we got a couple of quarters where, at least on a short-term basis, tariffs are going to hurt the profits.
Well, that sounds like, I mean, you must think that that's going to cap stocks, because you can't have the both.
Yeah, I think it probably keeps us here. I'm still using 6,500 for the S&P 500 by year end, and that's mostly because as the year passes, as we get through the second, third, fourth quarters, the market clearly is going to be giving more and more weight to next year. And I think the market so far, I would interpret the market's ascent here as an indication that investors have come to conclude that this whole tariff thing will pass. It's not going to pass for the second and third quarter results, but I think the market is going to look past it. We'll see how the guidance plays out. Maybe corporate managers are going to be willing to start talking about 2026 as a better year than what they're likely to show over the next couple of quarters.
That's kind of the view of my prior guest, Abby Yoder, is that as long as we've gone beyond peak tariffs, we're okay. Like, what could you possibly do now that would surprise us? I mean, I suppose something, but you know what I mean.
Well, I'm kind of concerned that the president might be upset that Wall Street has said that he's not steadfast with his tariffs, and there could still be a tariff war. I mean, there is a tariff war right now between us and China, and that's a significant issue. The rare earth minerals is a big deal, and are not buying Chinese goods because of the tariffs on them is a big deal. So there could still be some consequences from all that. But overall, you have to say, as your previous guest said, the hard data looks actually pretty good. Certainly the Atlanta Fed's estimates for the second quarters are spectacular. We thought a lot of the weakness in the first quarter had to do with really, really cold weather in January and February. And it looks like that was right. The consumer's coming back strong in the second quarter. And the other thing is capital spending. For all the talk about how uncertainty depresses capital spending, the reality is it's gangbusters, particularly on technology.
Yeah, well, I mean, technology's been unbelievable. Does that continue,
Correct.
Do you think?
I think it does. I think that there's a kind of a basic need to constantly spend in technology, because if you don't stay on top of the technologies your competitors do, you'll lose competitive advantage. So I think there's a great deal of pressure in that regard. I am somewhat concerned that this kind of AI technology race at some point may create way too much excess capacity, particularly in data centers. But for now, they just keep building these things, and that requires a lot of concrete, requires a lot of steel, and it requires a lot of NVIDIA chips.
Requires a lot of power, as we learned yesterday with Meta's deal and Constellation Energy on nuclear power.